Most traders mark supply and demand zones. Very few ever stop to ask the real question, are there actually any orders sitting inside the zone? That gap between drawing zone and confirming it is the difference between guessing and trading with intent. Here's the truth most traders never hear. A zone means nothing on its own. Price doesn't react to your drawings, it reacts to orders, real ones. And when you learn to see that where those orders are likely positioned before price even arrives, you stop reacting to the market and start anticipating it. In today's video, I'm showing you how to use Oanda's Open Orders tool to validate your supply and demand zones with actual market positioning data. You'll see exactly where retail traders are stacking orders, how to read that information correctly, and how to use it to confirm whether any orders actually exist at your zones before you ever risk $1. This is where zone trading stops being a guessing game. No more blind entries, no more second guessing, just a clean, structured method to know whether a level deserves your attention or deserves to be ignored. Let's get into it. Now, let's bring this onto the chart so you can actually see how it looks in real time. On the left hand side of the chart, what you're seeing is the order book visualized as a horizontal histogram. Think of it as a depth map of orders stacked at different price levels. The orange bars represent sell side liquidity. These are primarily sell limits above price and stop losses from buyers sitting below key levels. In simple terms, areas where the market could find selling pressure or where long traders are vulnerable. On the other side, the green bars represent buy-side liquidity, buy limits below price and stop losses from sellers above. These are zones where the market could find buying pressure or where short traders might get squeezed. Notice how certain price levels have much thicker clusters of bars. That's not random. That's where a large number of orders are stacked, and that's exactly what institutions are interested in. If you align that with the chart on the right, you'll start to see something pretty powerful. Price tends to move towards these clusters. It gets drawn into them, taps into that liquidity, and then either stalls or reverses sharply. Also, pay attention to the horizontal line running across the chart. That's marking the current price at that moment in time. Everything above and below shows you where the orders are waiting relative to price right now. And one more thing that most traders miss. This snapshot isn't static. As price moves, the order book shifts. Orders get added, removed, triggered. So what you're really doing is reading a live battlefield, not a fixed indicator. Once you understand how to read this properly, you can start combining it with your supply and demand zones. And that's where the real edge comes in. Because now you're not just marking zones, you're confirming whether there's actual liquidity and orders sitting inside them. You'll notice that the order flow is not evenly distributed across the chart. It naturally builds up around psychological levels, clean round numbers like 1, 110, 110.50 and 111. And there's a reason for that. Retail traders are drawn to simplicity. They place stops at obvious highs and lows, and they place entries at clean, rounded prices. It feels logical, it feels safe. But in reality, it creates clusters. So when you look at the order book and you see a large spike forming right on a round number, that's not random activity, that's a concentration of liquidity. And the key thing you're looking for is imbalance. If the bar at something like 110 is significantly larger than the levels just above and below it, that tells you one thing: that level matters. It's attracting attention, not just from retail traders, but from institutions who know exactly what sits there. Now let's break down how to read that. If you've got a dominant cluster of stop orders at a level, what you're really looking at is fuel, liquidity that can be triggered. That often leads to a stop hunt, price pushing into the level aggressively to activate those orders so the smart money can sell or buy into them. On the other hand, if you see a heavy concentration of limit orders, that's more like a wall, a level where price is likely to stall or even reverse. But the most powerful scenario is when both are stacked together. You've got stops and limits sitting at the same psychological level. That's what I call a maximum attention zone, a level where liquidity is high, participation is high, and the probability of a meaningful reaction increases significantly. So instead of just marking 110 as a key level, you're now asking a better question: what's actually sitting there? Right, so now that you understand how the order book works, how liquidity clusters form, and how they align with your zones, let's simplify this into a clear, repeatable process you can actually use. Because at the end of the day, you don't need more concepts, you need a framework. A step-by-step way to go from a blank chart to identifying high probability supply and demand zones that are backed by real market orders. And that's exactly what I'm going to show you now. Let me show you exactly how I'm using this in practice, because this is the part that ties everything together into a repeatable process. The first thing I do is not to draw zones. I'll start with the order book. I scan the histogram and look for the largest spikes, the areas where the orders are clearly clustered and stand out compared to everything around them. Those are the levels where the liquidity is concentrated and where the market is most likely to react. As you can see, the clusters are consistently forming around psychological levels, 155, 156, 157. Again, this isn't random. That's where traders are placing orders, and that's where institutions are focusing their attention. Once I've identified those clusters, then I move on to the chart. This is where I mark out my demand zones, but only after I already know where the liquidity sits. And what I'm looking for here is alignment. Does my demand zone cover the order cluster? Does the zone sit directly on top of a psychological level where the liquidity is stacked? If the answer is yes, then that's a high quality zone. If not, I'm going to ignore it. Because now I'm not just drawing zones based on price structure, I'm validating them with real positioning data. And if you look at the example, you can see it clearly. Each demand zone is sitting right over a major spike in the order book. That tells me there are actual buy orders inside those zones, not just theoretical interest. That's confirmation. So instead of asking, will price react here, you're asking, are there enough orders here to cause a reaction? Now, let's walk through this properly, because this is the process that brings everything together. The first thing to understand is this. Orders don't distribute evenly across price. They cluster, and they cluster around psychological levels. That's why when you look at the order book, you consistently see the largest spikes forming around clean numbers like 1.18, 117 and 116. These levels naturally attract attention, entry, stops and take profits, and over time, that creates concentrated pockets of liquidity. So instead of looking at the chart first, I always start by identifying those clusters. I mark out the key areas where the order book shows a clear build-up, especially when the bars are significantly larger than the surrounding levels. That gives me a map of where liquidity actually exists in the market. Then I'll move on to the chart, and this is where the process becomes structured. I start from the top and work my way down, marking each zone and checking if the orders are there. For each zone, I'm asking one simple question. Does this zone align with a cluster in the order book? If the answer is yes, if that supply zone sits right on the top of a high concentration of orders, especially near a psychological level, then it's a valid zone. It has backing and it has liquidity. If not, I just skip it and move on to the next one. Same process. Check the zone, compare it to the order book, and then look for the alignment. And as you go through the chart like this, from top to bottom, something becomes very clear. The zones that actually work, the ones price reacts from, are the ones that line up with those clusters of orders. You can see it here. The upper supply zones sit right where the orders have accumulated near those round numbers. Price pushes into them, taps into that liquidity, and then reacts. Then as we move lower, the same logic applies. When there's no alignment, no meaningful cluster, price tends to move straight through. When there is alignment, where the zone and the liquidity overlap, that's where you get a reaction from the zone. And that's the key shift. You're no longer treating every supply or demand equally. You're filtering them, validating them, only trading the ones that are backed by real order flow. Here's another layer to this, and this is where you really start to understand how dynamic the market actually is. The order book is not fixed, it's constantly changing. And you can see that clearly when I move the order book line forward in time. As price evolves, the clusters don't just sit there, they shift. Some grow stronger, some fade away, and new ones begin to form. Why is this? It's because traders' perception changes. As the market moves, traders adjust their positions. They add new orders, cancel old ones, move stops, take profits, and all of that reshapes the liquidity landscape in the market. So a zone that once had a strong cluster can lose that liquidity over time, and a level that previously had nothing can suddenly become significant as orders begin to stack there. This is why timing matters. It's not enough to identify a zone that had liquidity in the past. You need to know if that liquidity is still there now. And when you scroll the order book forward like this, you can literally watch that process happen in real time. You'll see clusters building as price approaches a level. That's traders positioning themselves. You'll see clusters disappear as orders get triggered or pulled. And sometimes you'll see liquidity shift from one level to another entirely. That's the market adapting in real time. So when you combine this with your zones, you're not just asking, was this level important? You're asking, is this level still important? And that's a completely different level of precision. Now, this is where a lot of traders go wrong, and it's important you get this part right. Just because you see a large cluster in the order book does not mean you trade it blindly. A big cluster doesn't tell you anything about the direction. It just tells you where the attention is. It tells you that something is likely to happen at that level, but not what is going to happen. and that's a critical distinction that you need to make. This is why price action always comes first. The order book tells you where to pay attention, but the candles tell you when to act. So if price pushes into a cluster, you don't jump in immediately. You wait. You watch how price behaves. You look for that reaction, the rejection, the shift, and then the confirmation. Because without that, you're still really guessing. What a trend. Stop hints and reversals work best when they align with the higher time frame direction. If the market is in a strong uptrend and you're trying to short just because there's a stop cluster above price, you're fighting the current momentum, and that's a low probability game. Instead, you want the liquidity to fuel the trend, not go against it. So think in terms of continuation setups. A stop hunt into a demand zone in an uptrend, that's where things get interesting. Third mistake, assuming every spike is a stop hunt. Sometimes price doesn't reverse. Sometimes it just breaks straight through a level, absorbs all the orders and liquidity, and then keeps going. That's why confirmation is non-negotiable. You want to see price move into the level, trigger the cluster, and then close back inside. That rejection is what tells you the level is being respected and the orders are actually being used and consumed. So no confirmation, no trade. And finally, let's bring it all together. Your best setups come from confluence, a psychological level, a large order cluster, alignment with higher time frame support or resistance, a strong spike and rejection candle, and ideally a volume spike on the wick. When you start stacking 4 or more of these factors together, you're no longer taking average trades. So now you've seen how this all comes together. You're no longer just marking supply and demand zones and then just hoping price reacts. You're using the order book to validate these zones, to see where the liquidity is actually sitting, and to understand what the market is likely to do before it gets there. And that's the key shift here, from drawing levels to actually reading the intent. Just remember, the order book is a tool. It gives you the context, it shows you where the opportunities are forming, but it's your job to wait for the confirmation, align with the trend, and then execute with discipline. If you can do that consistently, you're not just trading setups anymore, you're actually trading probabilities.